The home to the world's largest youth population, India, is set to overtake China as millionaires scramble to escape from the Chinese economy. Despite China's speedy development, there has been a continuous shift of money flowing into India rather than China. This diversion has been evidenced as the National Stock Exchange in Mumbai recently overtook the Hong Kong Stock Exchange, making India the fourth global financial center. Although the Indian economy faces many structural challenges, it is currently ranked as the top destination for global investment opportunities. Curious about the world's new interest in India? Join us to unveil why global investors are ditching China to invest in India. China and the pain from COVID-19. Following China's swift reopening after the COVID-19 outbreaks in late 2022, GDP growth is expected to rebound to 5.1% in 2023 from 3% in 2022. Growth was expected to be led by a recovery in demand, particularly for services. Similarly, investment was expected to remain robust, supported by slower but sustained growth in infrastructure and manufacturing investment, as well as the gradual stabilization of property investment. Net exports were also expected to weigh on growth due to softer external demand coupled with a modest acceleration in import growth driven by the increase in domestic demand. In fact, the Chinese government believed that to recover their fiscal policy, they're expected to remain expansionary, albeit less so than in 2022. Therefore, they trusted that monetary policy was likely to be relatively accommodating and policy easing in the property sector could be maintained before 2023. Over the medium term, China's economy continues to confront a structural slowdown. Potential growth's been declining, reflecting adverse demographics, tepid productivity growth, and rising constraints to a debt-fueled, investment-driven growth model. Structural reforms are needed to reinvigorate the shift to more balanced, high-quality growth. Therefore, there is panic in Beijing as investors are fleeing the country, dumping Chinese stocks and leaving China with nothing less than a loss of $7 trillion in less than 3 years. In the previous weeks, there's been a sell-off of almost $2 trillion in value. The problem is too big to ignore as President Xi Jinping has finally decided to take action, calling a meeting with Chinese regulators to improve global sentiment about China and its worsening economy. Although the meeting has not yet produced significant announcements, it's lifted Chinese markets. Nevertheless, major investors can no longer be patient and are moving their money to India, where they see a more promising investment destination. India, the Greenland for investors. India has faced several developmental challenges, but finally prevailed. After real GDP contracted in fiscal year 20 and 21 due to the COVID-19 pandemic, its growth bounced back strongly in fiscal year 21 and 22, supported by accommodative monetary and fiscal policies. Consequently, in 2022, India emerged as one of the fastest growing economies in the world, despite significant global environmental challenges, including renewed supply line disruptions following the rise in geopolitical tensions, the synchronized tightening of global monetary policies, and inflationary pressures. Compared to China, India has consistently proven to be a growth driver and has become increasingly preferred by investors. After COVID-19, it has speedily moved to become one of the world's fastest growing economies. The Organization for Economic Cooperation and Development, OECD, a 38-country grouping that advises policymakers, estimates that in the third quarter of 2021, India enjoyed 12.7% growth in its gross domestic product. GDP is the value added by a country's production of goods and services. Although OECD believed this growth was mainly driven by fixed investments and private consumption in its G20 GDP growth, the quarterly national accounts released, compared with a contraction of 11.6% in the previous quarter, show a total of $953.143 billion in foreign direct investment. FDI inflows in the country between April 2000 and September 2023, with its total FDI equity inflows standing at $654.929 billion between April 2000 and September 2023. Again, Prime Minister Modi also announced a special economic and comprehensive package of more than $270 billion, equivalent to 10% of India's GDP, under the Atmanirbhar Bharat Abhiyan Self-Reliant India program. Similarly, the Indian Ministry of Finance noted that India witnessed GDP growth of 6% to 6.8% in 2023. Furthermore, in fiscal year 22 and 23, India's real GDP expanded by an estimated 6.9%. This growth was underpinned by robust domestic demand, strong investment activity bolstered by the government's push for investment in infrastructure, and buoyant private consumption, particularly among higher income earners. The composition of domestic demand also changed, with government consumption being lower due to fiscal consolidation. Since fiscal year 22 and 23, there have been signs of moderation, although the overall growth momentum remains robust. Although the persisting headwinds, which is the rising borrowing costs, tightening financial conditions, and ongoing inflationary pressures, are expected to weigh on India's growth in fiscal year 23 and 24. The real GDP growth will likely moderate to 6.3% in fiscal year 23 and 24 from the estimated 6.9% in fiscal year 22 and 23. Additionally, the general government fiscal deficit and public debt to GDP ratio increased sharply in fiscal year 20 and 21 and have been declining gradually since then, with a fiscal deficit falling from over 13% in fiscal year 20 and 21 to an estimated 9.4% in fiscal year 22 and 23. Public debt has fallen from over 87% of GDP to around 83% over the same period. Also, increased revenues and a gradual withdrawal of pandemic related stimulus measures have largely driven the consolidation. At the same time, the governments remain committed to increased capital spending, particularly on infrastructure, to boost both growth and competitiveness. India is ranked 40th on the Global Competitiveness Index 2023. It jumped 6 places to rank 38 in the World Bank's Logistic Performance Index 2023. Also, 1.35 billion Indians are covered on the Aadhaar scheme, one of the world's largest social security programs. The government also organized the Pradhan Mantri Jan Dhan Yojana, a formalization of a savings scheme under which 500 million bank accounts have been opened with savings amounting to INR 2 million plus credits. In addition, the finance minister Sitharama announced the National Infrastructure Pipeline, NIP, a first of its kind initiative to provide world-class infrastructure nationwide. The NIP will attract investments into infrastructure and will be crucial for attaining the target of becoming a $5 trillion economy by fiscal year 2025. While nearly 7,000 projects across different sectors costing above INR 100 crore per project and totaling INR 111 lakh crore have been identified, sectors like energy, roads, and urban and railways amount to 71% of the projected infrastructure investments in India. Furthermore, an equity infusion of INR 6,000 crores has been made in the National Investment and Infrastructure Fund, NIIF, the infrastructure debt financing platform to attract debt and equity investments in infrastructure. The India Industrial Land Bank, IILB, a GIS-based portal, is a repository of all industrial and infrastructure-related information containing approximately 4,000 industrial parks mapped across an area of 5.5 hectares. China remains a growing influence. China's rapid growth is based on investment, low manufacturing, and exports that have largely reached their limits and have led to economic, social, and environmental imbalances. Reducing these imbalances requires shifts in the economy structure from manufacturing to high value services, investment to consumption, and high to low carbon intensity. Over the past few years, its growth has moderated in the face of structural constraints, including declining labor force growth, diminishing returns to investment, and slowing productivity growth. In the future, the challenge is to find new growth drivers while addressing the social and environmental legacies of China's previous development path. China's economic growth exceeded the pace of institutional development, and there are important institutional and reform gaps that China needs to address to ensure a high quality and sustainable growth path. The state's role needs to evolve and focus on providing a clear, fair, and stable business environment, strengthening the regulatory system and the rule of law to support the market system further, and ensuring equitable access to public services for all citizens. Given its size, China is central to many regional and global development issues. Although not the primary source of historical cumulative emissions, China today accounts for 27% of annual global carbon dioxide and a third of the world's greenhouse gas emissions, with per capita emissions now surpassing those of the European Union, although slightly below OECD average and well below the level of the United States. And its air and water pollution affects other countries. Hence, global environmental problems cannot be solved without China's engagement. China's growing economy is also an essential source of global demand. Its economic rebalancing will create new opportunities for manufacturing exporters, though it may reduce commodity demand over the medium term. China is a growing investment on other developing economies through trade, investment, and ideas. Many of China's complex development challenges are relevant to other countries, including transitioning to a new growth model, rapid aging, building a cost effective health system, and promoting a lower carbon energy path. Global China, regional influence and strategy, Brookings Institution. India, managing its newfound growth. India, being one of the fastest growing economies of the world, is poised to continue on this path with aspirations to reach high middle income status by 2047. It is also committed to ensuring that its continued growth path is equipped to deal with the challenges of climate change and in line with its goal of achieving net zero emissions by 2070. The growth of the past 2 decades has also led India to make remarkable progress in reducing extreme poverty. Between 2011 and 2019, the country is estimated to have halved the share of the population living in extreme poverty, below 215 per day, according to the 2017 PPP. However, poverty reduction has slowed significantly during the COVID-19 pandemic, but has since been reduced between 2022 and 2023. Despite the investors' interest in India, citizens have recorded that certain challenges persist. Many of the challenges include inequality in consumption, with a Gini index of around 35% over the past 2 decades. Also, child malnutrition has remained high, with 35.5% of children under the age of 5 years being stunted, and the figure rising to 67% for children in the 6 to 59 months age group. Although headline employment indicators have improved since 2020, still there are concerns about the quality of jobs created, the real growth in wages, and the low participation of women in the labor force. However, India's aspiration to achieve high income status by 2047 must be realized through a climate resilient growth process that delivers broad based gains to the bottom half of the population. Its growth oriented reforms will need to be accompanied by an expansion in good jobs that keeps pace with the number of labor market entrants. Thanks for watching. Do you think India's newfound economic growth and global interest will last forever? Share your thoughts in the comment section. Also, make sure you like this video and subscribe to the channel. See you in the next video.